Thank you so much. And actually, it's exciting. A little bit nervous of being here, but I just welcome the opportunity. Um, in our office, as you can well imagine, we handle all of the employee benefits for close to 500 employees, and that would include an array of medical insurance options, dental, vision, long-term disability, and life and AD&D, accidental death and dismemberment. So those are the kinds of benefits that we go out and work with a broker each year and renew and go to the market. Some we're able to engage in multi-year contracts so that we're not quite subject to the rate increases on an annual basis for every plan. And it's exciting. It's a dynamic arena, and we have, because we have just under 500, we are still considered a small group in the insurance arena, and that impacts our ability to negotiate rates. If once you hit that 500 mark, you're considered a larger employer, and you actually have more clout on the market. So we're getting close, but it's still a challenge. And then this year, the unique challenge of trying to anticipate how some aspects of the healthcare reform are going to impact us was a little bit nerve-wracking, but actually we did very well in our negotiations. So we spend close to $4 million on our what we call welfare benefits package for our employees each year. We pay 100% of all of our employee premiums. They are responsible for the family rates. So I understand that you have kind of a particular interest in not only the medical, but the long-term disability. Different approaches to disability. First, for short term, there's the state plan. You can stay on short-term disability for up to 6 months, and you just coordinate that with the employer. And we are even able and permitted to make up the difference and coordinate if someone has some sick leave on the books or vacation accrual. We can stretch that out as long as it's possible and as long as they still have a balance. But of course, it's not an easy benefit to get, but if your doctor authorizes that and provides documentation, that's one venue that employees pursue. Very few people, at least in my experience here, have needed to transition to the long-term disability. Almost every policy that I'm aware of requires that individuals apply first for Social Security disability. And if you meet that standard where you truly are disabled and it's going to be an ongoing situation, then the insurance carrier will pick that up. The most that I've seen in terms of coverage is about a policy that provides 65% of coverage. And that's a typical group plan. I personally have gone out and purchased a long-term disability wraparound at my own expense, which was not that expensive. When I bought it, I was younger, but it's just above a little bit over $50 a month. And our program at Cal Lutheran covers you for 65 or 66 and 2/3% of your lost annual income. And it also would continue to pay into the pension plan. So looking at your last full year's annual salary, our pension plan, CLU contributes 10% of an employee's base salary into the pension each year. And we would continue to do that. We pay it to the carrier and it's invested in the pension fund. The employee can direct that. So that's a nice added feature. And then the wraparound, usually between that, a group plan and the wraparound, you're able to protect yourself up to about 85% of lost income. There's a cap on that. The government puts a cap on that, and the industry has as well. So you couldn't quite get yourself to 100% of lost income. The general thinking in the industry is then there's no incentive for someone to try to get well and get back into the workforce. Although in most of these cases, and again, I don't think I've seen more than a half a dozen long-term disability cases in my career here. So most people do want to get back to work and get their lives back. So these are usually serious issues, medical issues that could not be overcome. One of our challenges I think I mentioned earlier was trying to anticipate what healthcare reform was going to bring this year. I think increasing our dependent coverage eligibility from age 23 to age 26, which was a mandate. And interestingly enough, the quote, children didn't even have to be dependents of their parents any longer under the tax guidelines. They didn't have to be living at home. They didn't even have to be single. They could be married and still remain on their parents' plan. We didn't have too many people who took advantage of that, so there wasn't a huge financial impact on the employer as we anticipated. There were all kinds of horror stories. I will tell you, we did well in our negotiations, and because we're on a level playing field, and all employers are required to provide the same level of coverage. For example, well care, there's now no cost for those well care checkups or baby well care. It simply has to be covered, and it's, simply there isn't even a copay for that service. But we didn't see our rates increase. In fact, this is one of the best years. The last 2 years, our benefits, overall benefits, increased just about 5%. This last year, we were actually just under 3% for all of our benefits combined. So that was amazing, actually, in one of our better years. So again, because I think all of the employers are on a level playing field, we're not competing, and the carriers have to provide that level of coverage too. So we didn't really see a heavy impact on our premiums. So I think I should stop for a minute and see if anyone has questions specific either to the industry, the insurance industry, or what we provide, and kind of give you a minute and kind of
Yes, I have one
weigh in on that.
in working with our clients in assessing their insurance coverages in the area of healthcare. We really need to be looking
Yes.
at the HR package. How do we go about getting that? Can we call the HR departments and talk to them as a financial planner?
Now, for the individuals, yes, we we have a lot of phone traffic and foot traffic. Now, we annually we have an open enrollment period, and it runs, for about a month. And we have all of the options posted on our website. We hold meetings. We also have a wellness benefits fair, and employees are encouraged to attend and bring spouses, family members, so that they can actually sit down and talk with a provider, with the different carriers. Although we do this on an ongoing basis through our office as well. It's a very personal selection, and it's emotional, and people are locked in for the year. They can't, if this is a plan they don't like, they can't just transition mid-year. They have to wait until the next open enrollment period. So they're committed, and the biggest decision is typically trying to determine whether a PPO is the best option or an HMO. Now, we happen to offer Blue Shield PPO and HMO, and we offer Kaiser. Kaiser is a very small group of people, but because they don't have a hospital facility in our community, it was a little holdout. And we know through our trip reduction surveys that about 85% of our employees, or almost 90%, live within a 15-mile radius of the campus. So we're very almost landlocked in terms of access to hospital facilities and preferences, and we want to pay attention to that. We also want to pay particular attention to some of our kind of the lower paid group of employees and people who may not have individual, personal transportation. We're limited in terms of public transportation locally. So we want to provide a plan that's viable where they can get to see providers and get to the hospitals physically. And if they were hospitalized, that family could visit. So we consider a lot of those options. So we go over all of the pros and cons. Of course, with the PPO, there's more out of pocket, but you're trading that for free choice. We have a $500 annual deductible for our PPO, which is still low. The national average is about $1,000 a year. Our maximum out-of-pocket cap would be worst case scenario that anyone would have to pay if they go to PPO facilities would be $2,000 in a year. So that's a fairly rich plan. For most people, that's not going to throw them into financial ruin, which is kind of a horror story that you hear from people who have to have individual plans that don't come with the employer. So that's kind of a benefit. And I see we've got a question: do we negotiate family deductibles and copay provisions in assessing health insurance possibilities? And yes, we do. We look at all of those features to see what is feasible, because we certainly know the salary ranges of the employees that we pay, and we know what's doable and what isn't. And we've really committed quite a bit of money to maintaining a healthy benefits plan, because we find more and more that that's a competitive feature when people are looking at where they want to work. That's something that helps us recruit good employees, but also in terms of wanting to treat our employees as well as we can. And yeah, I see the question about clients' cash flow. Is that the major determining issue when deciding between HMO, PPO, or point of service? It certainly is a primary consideration, but also people, about 2/3 of our people still go with the PPO. And they like the freedom of choice. They like it if they can move from doctor to doctor, they can go from hospital to hospital, if they need more answers, if they need a different approach to their care, if they don't get along with the doctor, or they're just, it doesn't click, they can go somewhere else. Now, with an HMO doctor, the reality is you can also, with the kind of plan we have, you can change doctors within that system. But I do find, and I think in some cases it comes with an educated workforce. Particularly, I notice among faculty that they do like that freedom of choice. So they are looking at the PPO as their preferred option, but we will continue to offer additional choices. And let's see, one of my favorite topics, are we involved if an employee leaves and elects continued coverage under COBRA? We are required, of course, to give all of that information to the employee when they leave for any reason, and we give them written documentation and information. They receive a letter from a third-party administrator. We contract with a company called Connexus, and they notify employees of the options and the payments. And so once somebody elects COBRA, they really don't interact with us any longer. Of course, I'll take their calls if they're having a problem, but they then interface with our third-party carrier when it comes to paying their premiums. And they would still have their ID card, and they have access to all of the same benefits. They're also notified during our open enrollment period, even though they're no longer currently employed. If they're still on COBRA, they have the option of changing carriers. And sometimes, because of the costs, people will move from a PPO into an HMO during that open enrollment period if they're on COBRA, because they're paying for their premium as well as family coverage. So we meet with them, discuss their options, and they have access to all the same information. And some people will come to our benefits fairs and still, when they're no longer employed, and they need that same amount of information. So yes, we certainly do that. Work closely with them. Yes, we do have a flexible spending plan, again, through a third-party administrator, but we have probably the two most popular options are the flexible spending account. As you know, the government just put a cap on that of $2,500 a year. It's down. We had just kind of been able to get it up to about $3,500 a year. So the most that people can shelter in the flexible spending now is $2,500. But we also have a fair number of people who take advantage of the child care benefit, and in some cases now actually the elder care benefit. So that they can put in up to $5,000 a year if they want to take care of the child care and the elder care accounts. So those are still popular. There were a few more restrictions imposed on what can be submitted for the flexible spending accounts now. It's typically been prescription only. They can deduct over the counter if it's also prescribed by a doctor and there's a note for it. So a little bit of limitations, but people do take advantage of it, and it's another cost-saving benefit that I think is appreciated. So I would say we probably have at least 100 people using that benefit, which is more than we have putting into their own individual tax sheltered annuities, by the way. So that's kind of an, we always try to encourage people to contribute more towards their own pension fund as well, because it's certainly not required. They don't have to match our contribution, but it's, I'm amazed at the people who don't take advantage of that option, because they own that contract. And anyway, that's, I think that's a challenge to get them interested and aware of what's available to them. To try to make them aware of benefits is a challenge for us. Pre-existing conditions, not really an issue any longer. We used to have a 6-month wait if you were in the PPO, not a wait if you went into an HMO for any pre-existing conditions, and now that's part of the healthcare reform as well. So the coverage is more immediate, and it really shouldn't be an issue for new or continuing employees, irrespective of the plan that they're in. So that happens to be a feature that I feel really good about, because people, by denying coverage, if someone was a cancer patient and in the middle of treatment and has to change jobs, to have to wait and spend a lot out of pocket on those serious medical conditions can often be catastrophic for employees. So I'm actually glad to see that piece of reform in place. In investigating individual health insurance plans, one of the things when I work with employees who may not be able to pay our premium for family coverage, or they're anticipating leaving and they might not want to pay our coverage, we work with them closely. I refer them initially to the websites where our own plans reside. So looking at, for example, a Blue Shield website, you can look at group plans or you can click on individual plans, and I've done it myself. And so, about at least 25 different options will pop up. It depends on the region in which you live. Pricing can be somewhat region specific as well. They'll ask your age and, without doing any kind of health history, and you'll see the different plans that will pop up for consideration. Anything from catastrophic only, high deductible plans, maybe $5,000 deductible plan. So if you select a plan like that, you're not going to get your doctor's visits covered and routine things covered, but you certainly have hospitalization. And again, if you can afford that $5,000 and it won't throw you into a financial tailspin, that might be fine. And a lot of younger people will go with that option. Or you can buy a rich plan that almost comes very close to a group health plan, but you'll pay more than you would through the group rate, and that's just a reality. Kaiser is very popular also, I notice, for some of the younger people, people who don't have insurance through an employer, as is the HMO through Blue Shield, Blue Cross. Any of the major carriers will have that option. Sometimes I'll just sit down with people and we'll pull up the website and look at the different features that are available. But people can buy insurance. It's not quite as rich as what an employer typically provides, but it is available. And it's a lot more readily available now than it was even several years ago. So that's where we start looking at that. And that way you don't even have to sit down with a private broker. You can kind of get a feel for what's out there, and then you're a little better informed when you go to sit down with someone and you know what to look at and what to ask for. So seeing the question about the cash flow issues, which I recognize. Optimal length of a waiting period. I'm not sure I quite understand in terms of waiting period. Would it be for the employer or for the individual? We provide benefits for our exempt employees the first of the month, and after they're employed, and so they have less than 30-day wait. For our non-exempt staff, it's a 30 days and then the next first of the month. So for some of them, there's a little stretch there. But most of those people are on COBRA already, or may have a private plan or covered through a spouse. So there's not necessarily a gap in coverage. People can't really buy into our plan. We'll often have employees ask if other people in the family can buy into our group plan. I just had a question this afternoon where a faculty member's mother is going to come and live with them, but we can't cover other than spouse, domestic partner, registered domestic partner, or dependent children up to age 26 on a group plan. So I guess, again, the longest that our employees would go would be just over 30 days in terms of waiting to get their coverage if it's a staff position. So hopefully not too bad and dramatic wait. I know some employers, it might be a 90-day wait, and that's tough. I think you'll find that in higher ed, we're much more, there's kind of a real social consciousness in terms of how we design our benefits and trying to meet the needs of a wide range of employees and needs. So that's kind of industry standard for us in higher ed. I'm trying to think of what might else. We were talking a little bit too about the life insurance and AD&D, accidental death and dismemberment. Life insurance through group plans typically cover you up to age 65, and our benefit provides 2 times salary up to a cap. If the cap was $250,000, I think it's just about doubled in the last year or so. We were able to expand that benefit, so I think it goes up to $500,000 now as of this last year. So for a group employer-provided life plan, that's good. But that's a fairly reasonable benefit for individuals to purchase. And if you have spouse and children, that's something that I think people need to consider very seriously. And I think that there's a tendency to want to save, but it's probably one of the most reasonable benefits I think people can buy that provides a real sense of security for a family. Yes, I see the question about converting group life. People can convert most of our policies actually on their own, and they definitely can convert their life insurance policy. So again, that's a continuation, and it's a pretty reasonable premium, I think. I'm sorry, I can't give you a set amount, but that's actually one of the more reasonable policies. We pay about $85,000 or $86,000 a year for about 475 employees to be covered at varying salary levels. So I think you can see that that's not a huge. For the basic life, it's about 12 cents per $1,000 worth of benefit. So you probably couldn't match that quite on your own, but again, that's a good option. I think what else might be, let's see. Oh, for a self-employed individual, a major medical versus managed care. Boy, that's a tough one, and a lot of that has to do with the individual's personal situation, their health. Managed care plans are comprehensive and provide a lot of options. And ideally, you'd like them both together in one program. But for a self-employed individual, I and maybe it's because of my age, but I would really like to see a very comprehensive program of benefit, because I'll tell you, looking at medical costs, lab costs, things that would be considered routine screening in some cases that are not protected or covered by healthcare reform, those add up into the thousands, and that could be on an annual basis. So it's really such an individualized decision. I tend to go for a comprehensive, like a plan that would cover both your major, your medical, your hospitalization, and some office visits. Like some of the plans I noticed would offer maybe 4 visits a year. There's a limit on some of those elements, and that also helps to keep the premium costs down, along with the hospitalization coverage and all of the catastrophic coverage. So that's a good catch. I think that's a good combination. So yeah, I think for the self-insured individuals, it's a challenge. I also know, and I believe that the California Chamber of Commerce also has plans for small employers with as few as just a handful of people, or one person all the way up to 50. I don't think you can get into a chamber plan with more than 50 employees, but there are different levels that you can purchase that if you're not a large group employer, that you can still provide something for employees. And oddly enough, doctors and lawyers' offices are horrendous, and they don't typically provide benefits, but they're out there and that is available. Let's see. Thoughts on long-term care. I have my own long-term care policy. I'll tell you, I think it's critical. Have watched, whether it's your own parent and so many other people now who need assistance. We're living longer. I think we're healthier than a lot of prior generations. But I'm just looking at the aging workforce, and boy, all of the boomers, we're going to hit that wall all at the same time. And so I did purchase a long-term care policy that also provides some in-home assistance if I needed it, and would allow me to be as independent for as long as possible. And I bought it probably when I was about 50-ish. And I'm only paying in the 50 some odd dollars a month premium, and for a plan that gives me some freedom of choice and some options where I go if I needed assistance, or again having help in the home, I think it's critical. I happen to be single, so for people who don't have children and don't necessarily rely on children taking care of you as you get older, I think I like the option of having that independent option, that possibility. I just hit this one. If a client stays working after age 65, should he sign up for Medicare or stay with the employer's health plan? I know a lot of employers are trying to encourage people to go with Medicare, but it's certainly not required. And Medicare alone won't get you where you need to be. I mean, most people, when they go and sign up for Medicare, then need to sign up for a supplemental policy as well. And if your employer provides the full range of coverage, and of course there's no cutoff for as long as you're working and you're eligible for benefits, I would probably say stay with the employer plan. Again, with Medicare and your supplement, unless the employer is paying you something to get your own benefit, if you feel that there's a decent comparison between the Medicare and the supplemental plan versus what your employer is providing, then that's fine. I know some employers are encouraging and providing incentives for their employees to move over to Medicare when they're eligible. I happen to sign up for Medicare at 65, only Part A. It's free. I'm not really using it. Kind of thought I had to, but I really didn't. But it's there, so I'm in the system. And when it's time for me to retire and take full advantage of all the Medicare options, then it will be quicker and a lot easier. So that's kind of where I'm filling up on that. Thinking about joining an HMO or PPO, any way to check satisfaction. I'm really Not sure. I mean, it's interesting because occasionally we'll hold a forum, and we'll have retirees come back and really talk about satisfaction levels or share kind of what's out there. I'm not aware now. AARP has some great publications, and they do discuss some of those issues in their publications. And so a lot of the customers or members of AARP, which is a huge, really, a group of people, they will weigh in and share their levels of satisfaction, and they'll even be very plan specific. So I think that's a good venue and a good forum. Not only publications, but there'll be a lot online through AARP too that people can check out. Locally, we have a senior center, we have some organizations, senior concerns, etc., and they will hold programs at those centers and invite the community. And that's another venue, really, where you can get additional information on how to assess the plans in retirement, how to assess your options. They'll have different providers come in and offer programs and speak to you about what their company offers. And so I think that's kind of the only way that I really know of how people who are actually in that situation then share their opinions. Good question, though, and I think that's important in terms of trying to assess your options. And don't forget, you're not committed for life when you select those options. You can transition from one plan to another at the end of a year if it's through your employer, and frankly at any time if you're just paying for your individual coverage. The managed plan of choice, I'll tell you, is the PPO. Again, about 2/3, at least 60+% of our employees go with the PPO, and they just like that freedom of choice. But the majority of our employees also are just getting their own coverage. They're not covering families. In many cases, spouses are working and have their own coverage. So we don't have, just looking here about, we really have on our PPO, we only have, because it's expensive, we only have about, maybe 30 employees out of 266 on the PPO plan who provide any kind of family coverage, whether it's spouse only or with children. We did try the point of service for several years and found it wasn't beneficial for us. It wasn't cost effective because people enrolled in it and then only took advantage of the PPO option. So we were paying for a level of flexibility that our employees weren't utilizing. So we dropped that option after several years and assessing it and talking with the benefits committee of faculty, staff, and administration, and wound up going again, I say, with the PPO and 2 different HMOs. So that's kind of the choice of preference. Think of what else would be interesting. Let's see. Looking at the question if both spouses are working. This is really strictly, not strictly, but primarily going to be a cost decision, I think, because most plans provide pretty comprehensive care. Now, if one person's employer has a richer benefit, depending on the family's medical needs, perhaps you're aware of some conditions where you're going to need a high level of coverage. You could go with either employer, but I would say you're going to look at the richness of the benefit. Our costs are high for dependent premiums, but again, you pay with pre-tax dollars, so that you're saving a bit of money there. So I'm not sure that it's a justifiable of thumb. I mean, I guess I would be inclined to say each person would stay with their employer-provided benefit. But again, there are situations where if you've got a serious medical condition that's going to be more costly and one has a better option than the other, a higher level of coverage, that's what you're going to look at. If there are restrictions, the maximum out-of-pocket cap per year is a big consideration. Again, our plan, the most an individual would have to pay out of their own pocket in a year, worst case scenario for our PPO is $2,000. So that's very rich. A lot of plans will have a $5,000 cap. So that's that's something to look at, and the cost of the premium as a dependent. So it's cost and level of coverage. So it is an individualized decision. But we do sit down with people and work through those options.
Well, Susan, thank you for being here with us today. I think we run through the questions. I certainly enjoy you being here and sharing all your years of experience with some really insightful, comments and things to think about. Thank you on behalf of the whole class.
Well, thank you very much for the opportunity.